Today, a spotlight on Maryborough, postcode 4650. Hello again, it's Martin North from Digital Finance Analytics Work Notice Post, covering finance and property news with a distinctively Australian flavour. In our one-to-one series, we do a deep dive on a particular postcode and discuss some of the dynamics of that particular suburb. And this particular postcode up in Queensland is a really interesting one, so I hope you enjoy my deep dive. And if you're interested in a one-on-one conversation, then you can contact me by the DFA website, and it takes a few days to do the research, and I have a number scheduled, but over the next 3 weeks I do have some space if you're interested in having a deep dive on a particular area. Anyway, let's now go and look at Maryborough. I just need to predicate this, as I always do, by saying this isn't financial advice. What I'm doing is just using the data from my surveys and from other sources to try and portray a bit of a picture of what's going on at the moment. It will change. This is a point-in-time view, but I'm not a financial advisor and this isn't financial advice. But I do take information from multiple sources, including my consumer surveys. All that information goes into my core market model, and that then drives all the things I do from the web, from the various reports, and this one we're doing today, right? That's the way the process works. The surveys every week, so it's very up to date. So we get information weekly. So it's not like it was sort of a year old or anything like that. So it's quite recent. Now, in terms of the core market model itself, we can take our mortgage stress data, the price history and trajectory data, the buying and selling intentions from the surveys, migration statistics, the CPI wages and employment data, other economic data. All of that goes into our core market model. We run different scenarios because there are lots of different things going on at the moment, but that allows us to form a view from where we are as to where prices might go. We could do that at a state, a region, or a postcode level, right? So that's where we get projections as well. So it's all coming off the model. So the location is Maryborough 4650, and I've just put a high-level map there first. It's good just to locate it. Nice area, interesting area. I always enjoy researching some of these areas that are perhaps a little bit out of the way because their dynamics are very different from, say, Brisbane or even the Sunshine Coast. It's a city, suburb of the Fraser Coast Region. There was a population in 2018 of about 27,000, but it's been growing just a little each year from there. And one of the things that comes up in the census data is that there's a predominant age group of 60 to 69. So you've got quite a lot of older households and families. And that means that some of them are still paying mortgages, which we'll come on to. And the occupation rate's reasonably high at 59.7%, but it does mean there are also quite a few people renting, and we'll talk about that as well. The more detailed map just locates the place. Obviously, Mary River is a critical element in and around Maryborough, and we'll talk about that because there are some questions we need to ask about flooding and other things. But that's roughly what it looks like. And I did just grab some photographs. Obviously, quite a nice number of old-style buildings in the centre of town. Some of them, preserved and very attractive. The area is quite well zoned and protected, and I'll talk about that in a second. If you come away from that, you obviously have the main drags and sort of the shopping centres as you would expect. Hungry Jack's and McDonald's are in town. Well, that's not surprising, they're almost everywhere. The river, of course, is a very important element here. It's obviously loops around the town. It's got some rather nice views there, particularly of an evening. And of course, you've got a lot of the old Queenslanders down the roads, wherever you look, pretty much. And I might highlight the fact that one of the things about Queenslanders is they're often on stilts. The reason they're on stilts is because of flooding. And the other thing that I should highlight is there is a bit of a development happening of multi-unit development on a single block. And the zoning allows that in some areas. So you'll see that there's some higher density zoning now happening. And what that basically means is you've got a series of townhouses or villas or units on one old block. And there's just two examples I picked up, both of which are actually blocks of multiple developments. In terms of the zoning, it's worth just looking at that. This is directly from the Fraser Coast site, but you can see there are a couple of areas where the high density development is now zoned, so high density residential development. There's also a few other areas there zoned as well, and also community facilities. So it's quite useful when you're looking at properties to see how it fits with the zoning that already exists, and you can actually drill into this in more detail if you see a local property that's of interest. I also looked at the flooding risk. This is quite important. There is a high flood risk, no surprise given the river. What I did there was I took the 11 metre and the 14 metre heights, right? The 14 metre would be a really aggressive one. The 11 metre one, though, is actually under the 1893 flood, which was 12.27 metres. So you can see that quite a lot of the place gets potentially inundated. So that's worth bearing in mind, both from a price perspective and from an insurance perspective. I did also look at the crime statistics. Nothing really to report here. This is pretty low relative to many other areas. I always look at flooding on crime as part of the research, just because in some areas the crime is significant. And again, that data comes directly from the Police Queensland data set, so you can go and click on that and see more detail if you want. What I then did, I looked at the housing units for sale in the area, and at the moment there are 93 properties for sale in Maryborough. I've put them on the map there, and you can see that there's quite a few close in, and then some spread around in the outer area too. And then I've just put a few up, really just to give you a bit of a sense. Queensland after Queenslander to an extent comes out there, but you get a rough sense of asking price. So it gives you a bit of a flavour of the sort of the range of what's around and the price ranges. That's one of the units in Churchill Street, so there are smaller places too. I highlight the fact that quite a few are actually showing up with prices, which is good. Others offers over, which basically tries to put a floor. There is still quite a lot of buy negotiation as well, and that basically says, well, it depends what you want to pay. So that gives you a bit of a flavour. What I would say is that generally, most of the properties here have a reasonable land area. Not dramatic, but reasonable. And I go back to what I said. In some areas now, they are allowing subdivision, and that's putting a little bit of price pressure in those areas zoned for higher subdivision. So that's just something to bear in mind. My read of what's going on here is we're going to see a lot more subdivision. We're going to see a lot more supply of these smaller properties coming on. And when I chatted to one of the agents, he did say, look, we're seeing quite a change, particularly in those areas that have been zoned first. His theory is that other areas will be zoned later for high density development as well. I can't see anything on the Fraser Council website to suggest that, but he may have an inside track, or he may just be making it up. Real estate agents do sometimes make things up. I tend to always just be a little bit skeptical and want to do my own research to make sure that I'm not being spun a yarn. But it is quite interesting. There are a few apartments. The proportion of apartments are quite low relative to houses in the area. I'll come on to that in a second or two as well. But you can get a bit of a flavour of what's going on. Now, in terms of sold properties, remember I said that was just under 100 to sale. Well, 44 sold in the last 8 weeks. So in other words, there's more coming on than going off at the market at the moment. And you can again see the sort of the footprint, a little pocket around Oakhurst, quite a few in and around the centre of town there. And again, I've just put some of the information with regard to price. What I would say is that asking price is not necessarily the same as the sold price. They don't often update this. And part of the issue is you don't know what the final settled price was until they settle the property, which could be 6 to 8 weeks or maybe longer after the sale has gone through. So they tend to report the last asking price. That can distort what's really gone on, and sometimes agents quite like to use that. So just be aware of that. It is quite difficult in Queensland to get good sold price information because a lot of it's privatised now. It used to be much easier, but that's just the way it is. So last asking price, and again you can see there that there's a lot of the old Queenslanders, some of the old weather boards, but you can begin to get a sense of the sorts of prices: 275, 225, 300 for houses. Obviously the bigger ones slightly more. I reckon that you can add, between 5 and 10% to the price for an extra bedroom. That's roughly the way I think of it on average. Obviously depends on the location a bit too. It gives you a bit of a flavour. I'll also make the point that there is also some land being sold, going back to that point about subdivision and also land for development. So that's another factor that's in the mix. People are actually selling off parcels of land and generating some extra income from that as well. So that's another strategy, I guess, if the plot's really big. What I did then was to look at the median house price in Maryborough, and the median is the one in the middle, so it's not, it sort of gives you a sort of a range in a sense. But so in 2013, the median price for a house was $205,000. No change in 2014. It fell in 2015, down 7.3% to $190,000. It rose in 2016, up 2.6% to $195,000. Rose roughly the same, up to $200,000 in 2017, fell in 2018, down 2.5%, rose 5.1% in 2019 to $205,000, and there was another rise of 7.3% in 2020, and a rise of 4.5% in 2021 year to date, so that's the half the year. So the average median price is around $230,000 at the moment, and the average gain over that period would be 1.7%, or line ball after inflation. So here what you're seeing is prices are pretty much tracking inflation over that period. There isn't really a lot of significant capital appreciation. You haven't seen much capital appreciation really over the last few years. The question is, remember, the population growth is quite low, and there is more industry coming, and that's part of the zoning that they've done. They are also building more properties, and they are allowing more subdivisions, so they are effectively seeing a greater supply of property. Remember what I said earlier, and that is that the number of properties coming on market are more than the properties being sold. So at the moment, there isn't the conditions necessarily for considerable acceleration of value, but the potential is there. Absolutely, the potential is there. And I'll show you a chart in a moment or two, which just makes the point about the difference between what's happened across average in Queensland and what's happening here. I will just quickly cover units, just because it's quite interesting to compare. Units have dropped down 0.7% over the same period, and in fact after inflation they're down 2.6% per annum. So people are losing here. So 180,000 the median for a unit in 2013, right? It dropped in 2014, rose slightly in 15, dropped in 2016, down more than 10%, fell in 2017, 165,000, rose in 2018, 180, fell in 2019, fell last year. So you've actually got a price of 165,000, which was the same as it was in 2017, and that's lower than it was in 2013. And it's dropped in 2021 year to date, down another 3% to 160,000. But there is some value there in units. And remember what I said about the fact that they're actually building a few more? There aren't that many in the place as well, so the supply is quite low at the moment. I think it will probably increase ahead. So that's quite an interesting, I don't think I've ever seen that sort of trend anywhere, so it's quite interesting. And then what I did, I just made a comparison between Maryborough, this is the median sale price, right, and the Queensland median sale price. Now you can see that, between 2020 and 2021, they're both tracking the same way, but the gap is what I'm interested in, right? 500,000 plus for the average across Queensland. Maryborough is just so cheap. It's amazing. I will say that there are a number of these locations around Queensland where effectively the interstate money has really not yet understood the opportunity, right? And I reckon there's a couple of dozen postcodes, but this is one of the best in terms of, the prices have been relatively stable. The location is actually brilliant in terms of its facilities, as long as you avoid the flooding. And there is some potential upside. I don't personally think there's going to be massive capital appreciation. But on the other hand, who knows? I will just summarise at the postcode level. There's 575 listed at the moment, with 150 added in the past month. So there is quite a throughput. If you go back to May 19, there were 1,140 listed in the postcode. 96% of houses. So that, units is a very small part of the story so far. But as I said earlier on, I think we're going to see that increasing ahead. The vacancy rates are extremely low compared with where we were in mid-May, 1.6% then, now 0.1%. There's only about 3 vacancies in the place. That's for rental properties. And the gross yields for houses around 5.3%, compared with 5.5% last year. And even a net yield, which is after all the costs and the cost of the mortgage and things, it's 4.5%. Now it's falling very slightly, but those numbers, 5.3 and 4.5, are some of the best in the country. And the rents are rising slightly, up about 3% in the last quarter. Typical rent's about $430 a week for houses. So it seems to me that there is an interesting story, which is an investment story here as well. The asking prices at the moment, they're pretty flat. There's been hardly any movement, around $330,000 for the average house. Obviously varies by size, as we discussed earlier. The average settlement is about 2% lower than asking. So people are settling just below the asking typically. We'll just go through units. So the gross yield this is for rentals on units, about 4%. That was a fall from 6.5% last year. The net yield's around 3.25. And that's quite interesting. Normally, the yields are higher on units rather than houses because the capital cost of units are normally much lower than houses. But because the capital cost of houses in this area are so low, in fact, the investment returns are better from houses than units. And the rents for units rising about 3% over the quarter, about $430. Now, again, what's interesting there is those numbers are, $430. It's pretty similar, right? Average asking price at the moment is around $300,000, right? And average settlements is around asking, but those are on small counts. It's pretty volatile. There aren't that many units for sale in and around the place. And from a rental perspective, from an investment perspective, right, these are really interesting numbers. So I think that's quite fascinating. And again, I've looked at a lot of statistics around the country, and a lot of places in particularly around Melbourne and around Sydney and New South Wales and Victoria, you couldn't see these numbers. They wouldn't be there, right? No surprise then that there are people looking interstate to come and invest in and around areas within Queensland because of these numbers, right? I will just go through the stress data. So this is my survey data. So in 4650, this is the total postcode. Yeah, well, it gives you quite a good flavour of, the nature of the market, right? So there's around 15,500 households in the postcode. There's about 4,700 borrowing and about 6,500 renting. And there's around 4,900 properties for rent across the postcode, and there's about 3,200 property investors living in the area. The overall financial stress measures 22%. Now, I measure stress in terms of cash flow, money in, money out. How are people faring? Are they earning enough to cover all their expenses, mortgage or rent or whatever, or are they not? And 22% is a really low number. So relative to the average across Australia, which is closer to 40%, that's pretty good. If I then break it down and look at the homeowners with mortgages, 1,300 have mortgage stress. There's no severe stress. So, mild problems. 27% in mortgage stress. The average across the country is 41%. So people are in less strife here. That's partly because the mortgages are so small, because the prices are so small, right? There's a little bit of default, but only 3%. That's not really too much of an issue. And rental stress is the other point. 1,587 in rental stress, 24%. Again, that's very low relative to the whole country. Up about 38, 39% across the whole country. So again, even those renting are doing reasonably well. And as a result of that, the investors also, only 16% of investors are stressed, and across the country that would be in the mid-30s. So this is an area which from a stress perspective is doing particularly well at the moment relative to many other across the country, and in fact much better than if I look down the Gold Coast or up to the Sunshine Coast, or indeed into areas of Brisbane. So this is a reasonably benign environment, and it's almost like going back in time. It's almost like this is what it was like in some other areas 15 years ago, right? So it's quite interesting. I did also just put up the trends. You can see that mortgage stress is rising a little bit. That's because now that JobKeeper and JobSeeker's finished, there are people who are finding it more difficult. And so ahead, the interesting question is, well, who's likely to sell? There are three groups of people. There are quite a few people who are in their 60s plus, still on a reasonably large block with a large property. And some of them are now thinking that it's time to move, to be able to sell, to be able to release equity, to be able to buy something smaller, either in the same area or reasonably close by. So those are what I call the down traders, and they're definitely the strongest group. So you'll often find an older property that's been lived in for quite some time, a family home, and now they're ready to trade down. The second group is there are a small number of people in mortgage stress who are being encouraged by the banks to consider putting their property in the market because their financial situation is a lot worse now than it was pre-COVID, and they're not getting the same support from the banks through the interest and principal relief schemes. The third group is some of those property investors who are looking at the recent price rise and thinking, well, maybe I should just release a bit of capital. Not very strong, but just a few of those. But the main is the down traders. So this is the people who are going to, I think, hit the market over the next few months. And in fact, when I was chatting with the agent, they know of a number of properties coming on from that group, probably in the spring. Now, the last part of this conversation is my scenario. So I run three scenarios. So the best case scenario assumes that the virus gets under control and that the borders reopen next year, and we spring back to a more normal mode of operation. The mid case is that we still don't get the virus completely under control. The borders stay shut for longer, and there is going to be sort of maybe partial openings, but not a full opening. And then the second wave is the worst case scenario, which effectively we get a variant that doesn't respond to the vaccines, and we have to continue to go through these lockdowns and things. Now, the point I'm making here is that the trajectory of the virus will determine, to an extent, what happens to property, right? So in those three scenarios, I'm looking at my estimates. Now, these are just estimates. They're not predictions. They're just based on what I know today. I'm suggesting that through 2021, the best case for houses could be a rise of 9.7%. Then a bit more of a rise in 2020. These are cumulative numbers, but a slight slide in 2023. So the next year or so will probably be the strongest growth. And I'm taking into account there some of the changes, some of the industrial use that's coming on stream, some of the demand that I'm seeing, but I'm also taking supply side issues into account as well. In the longer term crunch scenario, not such a strong growth level, 3.5, a small rise in 2022 and a slight rise in 2023. And if we really get another serious virus outbreak, then there's a bit of a fall. Now, I use the best case scenario in my modelling because at the moment the best case scenario has the highest probability of being the outcome that I'm seeing. But of course, if you wanted to use the other ones, you get a different outcome. And if I then apply those uplifts to houses first, so this is the same chart, but I've now extended it. So I'm saying that there's overall, for 2021, 14.3% rise, of which we've had 4.5% so far, and that would take prices to about 250. Then a rise next year of 4.5% to 262, and then there might be a very slight adjustment or static in 2023. So a bit of a peak over the next year is what I'm suggesting. Not a massive rise, but a bit of a rise. And then if I did the same with units, a bit of a similar trajectory. The growth levels are not so strong. So 12% over 3 years, best case, rather than what we had previously, and a slight fall in the second wave. And then I apply that to the modelling going forward. So basically we see prices through 2021 up 4.8% over the year to 173, then 2.2% higher, 177, and another 2%, 180. And if that was true, then we'd be looking back to where prices were in 2015. So anybody who bought here would be probably be okay, but if they bought at different points, might be a different story. But again, my sense is that there is a little growth, but not a lot of growth. And so if I sort of come back and summarize that, I think this is a gem of a location. I think that relative to many other parts of Queensland, the prices seem to me to be extremely reasonable for what you get. There are some risks relating to flooding, which you need to take account of. There is a little bit of growth in terms of the future development of the area. Some industries are coming in and those sorts of things. And I also think that this is the sort of location that may start to attract more interstate interest, simply because the investment returns are so good relative to what I'm seeing elsewhere at the moment. There are a number of nice properties there. Probably some of the older ones, some of the old Queenslanders, is worth getting a survey, because there might be structural issues relating to them, which of course is always an issue with older properties. And we also expect to see more knockdowns and rebuilds in the area, some of those subdivisions, some not. And so there is a bit of a sort of a changing character at the moment, and the latest council zoning allows for some of that. But it is controlled, so it's not like it's going to sort of suddenly be destroyed and it will suddenly look like the centre of Brisbane. But nevertheless, I think this is an area which is probably going to continue to develop over the next decade or two, and therefore, unless we see significant financial disruption internationally, you'd think that one, properties will hold their value from where they currently are, and two, there is some prospect of some growth, not dramatic growth, but some growth over the next few years.